Welcome back. Adjusting the Accounts, Part 1, Accounting 201. I'm Judith Peckett. We are going to do the adjusting journal entries. In the previous videos, we covered basic journal entries, posting those to T accounts, and creating a trial balance. And now we're going to do adjustments, and they are done at the end of a period, a month, a quarter, or a year. We're going to post those adjustments to the T accounts, run a new balance, and get a final trial balance. And then we're going to publish final financial statements. Issues to consider with adjustments. There are timing issues. There are two types of adjustments: major category prepaids and accruals. Prepaids are also called deferrals. Deferrals is just a fancy word for prepaid. Buy now, expense later. And accruals, an unrecorded transaction has occurred that must now be recorded. Timing issues. We're going to talk about the fiscal year and the calendar year and what is the difference. We have accrual versus cash basis accounting. I'm going to show you why we prefer accrual accounting and in fact are required to use it. And we're going to talk about recognizing revenue and expenses. Fiscal and calendar years. Financial statements cover an arbitrary period of time, a month, a quarter, or a year. A calendar year ends December 31st. A fiscal year is the year that the company decides. Many companies use a calendar year as their fiscal year, but many other companies do not. For retail stores, the fiscal year ends around January 31st. Why is that? Because January is a key month in the year, and December 31st isn't an accurate reflection of the end of the year. There are many returns in January, and they consider January to be part of the previous year. Financial statements are reported using the company's chosen fiscal year. Accrual-based accounting. Transactions are recorded in the periods in which the events occur, not necessarily in the period in which the money changes hands. So revenue is recognized and recorded when it is earned, rather than when the cash is received. It can be when the cash is received, provided the timing is such, but it doesn't have to be. Expenses are recognized when incurred, not necessarily when paid. Cash-based accounting is always about the money. Revenue is recognized when cash is received. Expenses are recognized when cash is paid. Cash-based accounting is not in accordance with generally accepted accounting principles. However, cash-based accounting, basis of accounting, is what most of us use in our personal lives. So we're going to talk about revenue recognition principle. This is a really big deal in accounting, and it often comes up in fraud investigations. When do you get to call it revenue? The test is, was the service completed? We're starting out here with service businesses, so it's a question of, was the service completed? When we start selling products, we're going to say, when was the product delivered, or when did title transfer on the product? So companies recognize revenue in the accounting period in which it is earned, and the test for service enterprises is, when was the service performed? Expense recognition principle is also called the matching principle. And we want to match the expenses in the same period as the revenues that they help to generate. Expenses are recognized when incurred, not necessarily when they are paid. So, quick example. The company provided 20 hours of advertising services and earned $2,000 in revenue. During the same period, the company should also record its expenses, such as supplies, for supplies used, and salary expense for its labor costs. Here's a story to show you why accrual accounting helps us. A man, J1, starts a company. The company paints buildings, and they're called Sky High Painting. J1 invests $60,000 of his own money in Sky High Painting. Sorry, I got that twice. The company is started on December 1st. He gets the job to paint a big building in downtown Bellevue. He hires employees and he buys paint. They paint the building. He pays all of his expenses, and they're $50,000 in cash. He bills the customer for $80,000, and he goes home on December 31st. Sorry, that should say 2013. He gets hit by a car on the way home and he dies. I realize that's kind of dramatic, but it makes a good story. Okay, his wife survives and she decides to sell the business. So she has the accountant put together an income statement for year one, which again is only 1 month of activity, and then year two, as she wraps up the business in January. Let's look at a cash accounting. Now this is very simple. If we reported all the revenue in year one, we would say we had no revenue because the company was not paid. But since the company spent $50,000 in expenses, using cash accounting, we would say year one we lost money. Year two, again using cash accounting, we would have been paid $80,000. But the company is closed. There's no business, so expenses were zero, and we would report net income of $80,000. Now, cash accounting doesn't really tell the true picture of how this business was doing. It's better to accrue the revenue in year one. We have earned it. We have billed the customer $80,000. We had expenses of $50,000, and we have net income of $30,000. Year two, it is true we got paid, but we didn't earn any more revenue. We didn't spend any more expenses, and we had a net income of zero. And that's more accurate. So we can say that cash accounting does not give us the information we need to analyze our business. Plus, it's not in accordance with GAAP. Accrual accounting tells us how we're doing. Going back to Sky High Painting, that's a very profitable business. They made $30,000 on $80,000, and we can see that using accrual accounting. We don't really have a good picture here of how well this business is doing. Adjusting journal entries give us the correct amounts on the income statement and balance sheet, and you will see that in the upcoming 2 videos. Every single period, accountants must review the accounts and determine whether adjusting entries must be made. There isn't usually a document that is like a bill that shows up. It's usually more of an accountant analyzing the different accounts and making that determination. And we'll work through some examples. Every adjusting entry will affect at least one balance sheet account and at least one income statement account. And finally, cash is never, ever one of the accounts used in an adjusting entry. One more reason as to why we need adjusting journal entries. A company buys supplies for $900 at the beginning of October. And I want you to think, what would that journal entry be, and how would I post it to T accounts? This should be more and more familiar to you. But let's go on. At the end of the month, they go into the supply room and they do a physical inventory, counting all the supplies, and determine that there's only $250 worth of supplies on hand. Now the supplies account is still going to show $900. So my question to you is, how do you write down the supplies account to its current actual amount of $250? Answer, you're going to find out in the next video. Adjusting entries. Revenues must be recorded in the period in which they are earned. Expenses must be recorded in the period in which they were incurred. Adjusting entries ensure that revenue recognition and matching principles are followed. So, there are 2 major categories of adjusting journal entries: prepaids and accruals. The prepaids have 3 prepaid expenses and 1 unearned revenue adjusting journal entry for a total of 4. The accruals have 1 accrued revenue journal entry and 2 accrued expense journal entry. You need to know the basic 7 adjusting journal entries. There are more, but they're just variations on these, and they all follow the same pattern. This ends part 1 of adjustments. Next, please see next video, adjustments part 2.